All right, so let's get started. Good morning and afternoon and good evening, depending where you are. This is our sixth Zoom event with our China chapter. My name is Daniel from. Today we have a guest speaker, Mark Schaub, who is going to do the topic, why joint ventures are on the rise in China. Mark's been a corporate lawyer since the 90s. And he's with law firm KWM, and he's been with the company since 2000. And before we hand it off to Mark, I just want to add a note that feel free to ask questions to Mark as he's presenting. You can also throw your questions in the chat box and they can collect there, where I can also be asking those questions to Mark. So without further delay, Mark, I'll let you lead.
Okay, thanks very much, Daniel. Hi, everybody. I'll just see if that works. Okay, so I guess everybody, Daniel, you can see the screen, is that right?
Yep.
Okay, great. Okay, well, thanks, everybody. So like Daniel mentioned, I've actually been working as a lawyer in Shanghai since '93, and I joined KWM in 2000. And I normally spend my time now since 2018 between Europe and China, but obviously I don't get to leave the house at the moment. I'm stuck in London. So over that time, since the early 90s, we've been involved in a lot of joint venture cases. Okay, sorry. So I think, just to reiterate what Daniel said, please feel free just to interrupt, ask a question, or say that you have a different experience. Very happy to have a bit of a dialogue. So I think when I was first there in China, in the early 90s, we did see quite a lot of joint ventures in China, but it was often, I was working at a German law firm back then, and most of our clients were in the auto industry. And so the auto industry was really a place where Volkswagen came in, and then later companies like Daimler, BMW, General Motors. And it was not just those companies were joint ventures because of legal restrictions, but also a lot of companies were coming in because they thought they needed to secure the supply chain, or they wanted to have the local market know-how of the Chinese partner, dealing with local officials and things like that. And so I think a few years later, people weren't interested in doing joint ventures because a lot of the joint ventures, they failed after a certain period of time. And now I think the world's changed again. So early on, people were doing joint ventures because they thought it was a good way to start making things for export, or to sell to businesses who are making things in China. Later, people were doing wholly foreign-owned enterprises because they felt they could do it by themselves to manufacture. And now I think in the last 5 years or so, we've seen that China's not just an importer of capital, but it kind of creates things, has a massive market, and also exports capital. And we've also had, maybe in the last 10 years, the rise of private equity, and these companies are finding difficulty in finding new projects. So what we're seeing now is foreign companies, a lot of them are high-tech companies, either US or European companies, and they're looking to do a smart joint venture. So it's not a joint venture which is just because they think they need a Chinese partner or they need a competitor. They're looking for a good partner who can really give them some really useful technology, some innovation, maybe also some overseas distribution. But crucially, the main thing is they're looking for someone that can make them, they can do together a successful business on the Chinese market. And so nowadays, I think if we look at our international clients, almost 90% of them, if they're coming to China, they're targeting the Chinese economy. They're not trying to export anymore. And so I think we've got a few clients at the moment who are working on joint ventures with large Chinese, very successful companies, because they think it's better to have, say, 25% or 30% of a successful joint venture, because they can handle the US or Europe by themselves, but they feel that China, it's too big to ignore, but a bit too difficult for them to handle by themselves. So for this reason, I think we're seeing a lot more joint ventures again. So I won't spend much time on the joint venture per se, but basically it's quite simple. It's really a foreign entity and a Chinese entity enter into a joint venture. There's a few different forms. There's an equity joint venture, a cooperation joint venture, I've only ever seen one cooperation joint venture, and they're typically for real estate plays. So I think they're relatively, they are relatively rare. But almost all joint ventures are equity joint ventures. And I think
Hi,
this
Mark.
list of the, sorry?
Mark, can I just jump in for a quick question? Just curiosity. I think, the first slide you mentioned, in the early 90s, obviously, it's a very different time in China as compared to now. I think what they were looking for in China was technology, cash, and obviously manufacturing know-how, right? I mean, it's definitely played out over the last 30 or 40 years or so. Today, with China, it's a much different economy, very sophisticated technology. What do they need over there? Thank you.
Yeah, thanks. So look, I think what they're looking at is the sectors that are hot in China are also hot for. So China is, I think, the second largest importer of foreign technology in the world. So this includes license fees and this. And so if I'd say what we see the most of, it's digital tech, it's life sciences and healthcare, and it's services of software companies. All these companies are coming to China, and they often need to be adapted. So just yesterday, we had a call with a services of software provider who's successful in Europe, but they do something for an insurance claim type of software system. So they've got a Chinese partner, and they'll basically cooperate. The Chinese partner will handle distribution and also product localization, because obviously the market's not the same. So I think we're seeing a lot of that. I don't think that we see many of the traditional joint ventures. You do, like manufacturing of a car or furniture. It's much less that. I think most of the joint ventures we see have a technology element. And I think the thing is, it's the Chinese partners have become, I don't want to say arrogant, but they become much more self-assured. So 10 or 15 years ago, if you were an American company or a German company or a Swedish company, the Chinese were very respectful. Nowadays, it's much more like, well, what technology you've got? Why is it better than what we've got? And so, we've had a few clients who really thought their fintech was really great, but they couldn't impress the Chinese side. Or, someone who thinks WhatsApp is better than WeChat, very hard to convince people. So I think there's lots and lots of scope. And I think probably the biggest single sector is life sciences, healthcare, old age care, those kind of things. That's what's really driving the market. Okay, I hope that answered the question. Here, I think when you look at the joint venture, the main issues, it used to be longer, but it's really more about the shareholder ratio, because this will affect the composition of the board, liquidation in the worst case. So you really have to know if you're a 60-40 or a 50-50 joint venture, or like I just mentioned, that one yesterday, which we were talking to, they're looking to do 25-30% of the joint venture, and they actually want the Chinese partner, who interestingly enough is actually a Sino-foreign joint venture, they want them to take the ball and run with it. They just want to, protect their IP and some other issues. And then I think, after the shareholding ratio, probably one of the issues is about 51 to 49. I think for foreigners, if they really want this, it's always a little bit weird. It's often if you've got a large state-owned company or listed partner, they will really want 51% because of the consolidation. So they want to put the financial results into their balance sheet. And so the next big issue is the board of directors and the management. So these are the kind of issues that we see get discussed, quite a bit. So I'll run through these very quickly. But when we look at a structure, I think one of the first questions I'd ask myself is this a state-owned company that's my partner? Are they going to insert any or contribute any state-owned assets? Look at the joint venture contract, how best to protect yourself. But I'm not a great believer in contracts. I think you need a contract. The contract should contain safeguards, but it's more important to have the right partner with a bad contract than a great contract with a bad partner. So obviously the best is if you have a good partner with a good contract, but make sure the documentation, it's realistic, that it's not, that you have things that you can't enforce. An example is you still see people who try to do contracts in China with, New York law and New York courts. Obviously for a joint venture in China, that's not even legally possible, but like a New York court judgment is almost impossible to enforce in China. So it's probably better to have Hong Kong arbitration or, even CATEC arbitration. On management, I think just because it's a bit of a diverse audience, I think the issue is Anglo-Saxon companies who invest in China, they will often have a hierarchical management structure, at least the ones which we see, where they have a general manager and then maybe a deputy general manager. Whereas European companies will often have what we call an ex-com. And so the ex-com will have the general manager who's perhaps got overall responsibility, but he's just the captain of a team, and then different people have different rights. So that might be something to think about. I think the ex-com actually, if it's a big joint venture, it can actually work better because there's more of a dynamic of cooperation rather than the hierarchical approach. So that's just something for people to think about. And then I think the intellectual property is important. How do you value it? There are restrictions on how much can be the IP, but there's ways to get around it if people want to discuss that. Important is to establish your IP rights in China. Except for copyright, other rights have to be established. So if you want patents, you're gonna have to register them there, trademarks, make sure you own it. And if the joint venture is going to adjust it, you wanna make sure that you own those adjustments, or at least you get a royalty-free, exclusive, irrevocable right to use those additional improvements overseas. And then equity transfers, I just put it in there because a lot of people ask about this, but at the moment, there's really no easy silver bullet. It's not like you can have this call or put option. These things all make sense, but you have to be very, very realistic between what you write on paper and what you can enforce. And I'm happy to take questions on that. So I think it's very important when you do the contract in China, it shouldn't just look good on paper. You should think how it could practically work for your benefit if you had a dispute or if you were in a struggle with the partner. Okay, if there's no questions on that slide, I'll continue. So compliance, I think, is a big issue. We still have it, especially with US clients, I think more than the European clients. And so there's a lot of concerns when you're doing due diligence. And I think sometimes with joint ventures, it's a bit difficult because, the most suspicious company I ever found when we were doing due diligence was a Chinese privately owned company that had 100% record of compliance. And so I really thought we must have missed something, but it was explained to us that the owner wanted to do an IPO with this company. So from the very start, he did everything in a perfectly compliant way. So I think if you're going to do a joint venture or you're going to buy into a Chinese privately owned company, you have to make a distinguish between like toxic non-compliance, or compliance that you can correct and improve. Another issue is the operational qualifications. We're doing a project at the moment, which is in a very restricted area, and it's very difficult to get the operational licenses. So one of the big issues for the client will be, there's no guarantee, even if they do a share deal and they buy the company, that those operational licenses, because they're subject to shorter renewals than the lifespan of the joint venture, whether or not that operational license may be difficult to renew. So we've also had those kind of cases as well. On the rest, I think the approvals and that stuff, it's all kind of clear. You just will need approvals or filing. Some things are off limits, some things are encouraged, most things are permitted. And I'd say the trend, since the 90s has been to liberalization, but a bit like the first question, what are the hot areas? You can guess what the sensitive areas are. They will be things like media, certain types of training, certain types of value-added telco services. So, if you're in a business that could be sensitive or slightly sexy, it's more likely that it might be restricted. But then there might be things that you're not expecting. Like I was surprised, it's very hard to do anything in rice or do corn crushing plants. So these were things which I didn't think were difficult, but these are also very restricted. And so the last point, which I should really put at the end, not approvals, but is about exit. And I think the thing is, joint ventures do have a lifespan. And I know that people don't like to think about it, but it will end. And so even at the start, you should start thinking about how to strategically put yourself in the best position for the eventual exit. Now, this might sound a little bit shocking to some people. I'd say the average lifespan of a joint venture is about 10 years. So it's about the same as an octopus or something. So, some will fail earlier, normally maybe 7 years. It's rare for them to fail earlier than that, or they fail very quickly, or they can last longer. But, I think at some stage, the partners, the Chinese and the foreigners, why'd they come together? Normally the foreigner was interested in the Chinese market, and the Chinese partner was interested in the technology or the investment or something. And so over time, these interests no longer align. And, we've had cases where a German company did a joint venture with a Chinese company, maybe 12 years ago. And when it started, the Chinese company was quite small. And today the Chinese company is 6 times larger than the German company. And so the joint venture, the Chinese partner wants more and more technology, wants to expand the products of the German partner, but the German partner wants to still have its own products and only wants to stick on that. And so that joint venture ended up going apart. And strangely, perhaps, the relatively rare occurrence, never used to happen, happens more often now than it used to. The Chinese partner bought out the Germans' interest in that joint venture. So think about the exit, and we might touch on a bit, or someone might have a question. One thing about these technology companies, a lot of them are looking for an IPO in China as the exit because of the Star Exchange, which is like China's NASDAQ, has been just hurtling along, collecting so much capital. So that's an exit. Whereas 10, 20 years ago, there was no exit plan. It was like, we'll do a joint venture, and I don't know, the exit plan is we'll just keep on doing the joint venture. Now I think people have perhaps a few more ideas. So I think dealing with your partners, and obviously every joint venture is unique, every joint venture partner is different, but I think a few main issues are, don't be fooled by guanxi, which is, I've got all these great connections, I've got all these great relationships. It's true that relationships are important in China. It's also true that they're important in America or in UK or anywhere. So make sure you get the right partner. Don't be fooled by a beautiful story. I think the other one is a bit about flexibility. I think if you're a medium-sized family business and you make all the decisions and nobody ever queries you, you may not be the right person to do a joint venture with a Chinese partner. Make sure you really work out the stakeholder analysis. So this again, I mean, everything is bespoke. It's different if you've got your market and you're selling, but let's say if you're setting up the joint venture because you're trying to sell to a sector which is difficult, like say the railway industry, because even though it's open for procurement to a degree, you often need, in order to succeed in a tender, you must be a joint venture, for example. So really work out is your joint venture, do you not just satisfy the Chinese partner, but are all the stakeholders happy with the concept? And then I guess the other issue is about clarifying the decisions right at the start. And this is often a lot of joint ventures, because a lot of the joint ventures are done in engineering type companies. And so engineers often lead it. And sometimes the engineers, they get frustrated with lawyers saying, we need to really, make this very clear. And they'll say, let's sign it now and we'll work out the details later. This is very difficult. So I think, it's really important to make sure everybody's aligned on what's the decision-making process, the roles and the responsibilities. You don't want to find out that there's a real non-alignment after you've half built the factory. So I think these are just, obviously common sense, but some of the things we've seen. Okay, I might skip that. I might say that too. So I think which joint ventures work successfully, I think perhaps the ones which work most successfully is where you do have the alignment. And, a joint venture contract, it's, signed, maybe it's got 20 years, maybe it's got 50-year term, but it's signed on day one. And, very rarely do people change it very much unless they're increasing the registered capital or they're doing something very small. So it is a bit unusual that the joint venture is such a static document. And so I think by its nature, since the joint venture is very static, I try to put things which are more dynamic into annexes which don't need to be approved and filed in public. So things like the management bylaws and things like that. And then I think also the business plan is very important to make sure that you continue being aligned as the market changes. Because we'll talk a little bit later a bit about why joint ventures sometimes have problems. And I think one of the reasons why they have problems, or not one of the reasons, 70% of joint ventures that have problems, it's an economic problem. And then it feeds into a cultural problem, and then it feeds into a shareholder dispute. So I think, make sure you're aligned on things like, what's the focus of the joint venture? What products you're doing? Are you trying to increase your revenue, or are you trying to maximize your profit? How short-term are you? How long-term are you? What's the capability transfer? What are you trying to keep offshore? What are you trying to bring over? And how are you actually doing the technology transfer? And then finding the right partner, like I said, it's really the most important thing is the right partner. With the right partner, you can solve most problems, but if you have a bad partner, no contract will really help you. Obviously, it will help you somewhat, but it's better to have the right partner from the start. I think also people now have to give up the idea that they're always in charge, that it's a 51-49 joint venture, but you've got 100% of the say, or you're going to tell everybody how to direct traffic. I think in some cases, you might want to give up control to the stronger Chinese partner, and you're more of the technology, perhaps international flair, but they can really drive the business. You keep on adding value, but you actually create a very valuable business in China. I think another issue is the right team and the governance. So you need to have China capability, I think. And I think head office needs to be involved, because I've never really understood how you can have a successful joint venture if head office just allows the people on the ground to do everything and they're never really involved. I think that it's not really a sensible joint venture. So I think, you'd really would like head office to have some role, visit regularly, attend board meetings, and really work out how to bring the business forward. Daniel, I don't know, I see somewhere at the top it's got like 7. I don't know if they're questions or something else. I didn't want to open it in case I did something. Will you read the questions as we go along, or are you going to save them up, Daniel, just to have interest?
Yeah, absolutely. I can ask some right now. One here is it possible for a foreign partner
Okay, sorry. Okay.
to be the GP?
Okay, so Daniel, you're breaking up for me. I don't know if others can hear
there.
I think I've successfully opened up the JV.
And is
Yeah. So I think in the cases on the GP, this is a new one which I think is that it is possible. I don't think that the Chinese part, it will depend on what sector you're in, but I think it's not necessarily an issue of the Chinese always having to be the GP. I think another one is somebody wrote, Steve Schnell wrote, he was in General Motors when they did the JV, and they were mandated to form a JV. Now, so that's a very interesting example, and I think we've got it here. We've got General Motors and SAIC, and also, all those auto companies. Tesla was able to negotiate a new deal. So, and our firm, I wasn't involved, but our firm in Shanghai was involved in it. But for a long time, China had restrictions. It was, I think, the 2+2 restrictions. So not only could you not get more than 50% of a passenger car or a commercial truck joint venture, but you were also limited to 2 joint ventures in 2 categories. So that was a big restraint on the foreign companies. But I think now, as China has become more confident about its own ability to be an innovator in the automotive space, and as perhaps the gas type cars are leaving and we're looking at new energy vehicles, you actually will see that China has recently loosened the restrictions so that foreign partners can own a majority in those kind of joint ventures. Because I think this is just an indication, when China's auto industry was very weak, they wanted to make sure that the joint ventures were 50-50, and also that there were forced technology transfers back then. But as they've become more confident, they're much more happy to have it. And I think probably they think the old gasoline style motors are probably the old type of business. And so they're much more interested in electrical vehicles and also things like autonomous cars. So I'll keep going. I'll try and keep an eye on those chats, but I don't know if I can always see them. So just here, I think joint ventures that work successfully, a lot of them are big ones. So, Airbus, BP, GM, Volkswagen. And so I think one of the reasons is if you're a big company in the West and you're doing a joint venture with a big company in China, it may not be a great romantic love story, but you have the resources to deal with it. You have, it's like a corporate type of big deal. I think, we have medium-sized companies do successful joint ventures, but that's often that the management really does get on well with the Chinese partner, and they've built up perhaps first a supplier relationship before they did a joint venture together, and there's some human element of it. I think perhaps the most difficult joint ventures are large companies, which are not as big as these giants, but they try to do joint ventures with partners who are quite different from them, and it's quite difficult. So, I think joint ventures that work successfully is where the partner is in some ways a bit similar to you. Okay, I don't know what's happened now. Okay, and so I think we segue now from joint ventures that were successful to the ones that blow up. And so I think, look, almost every joint venture I've done, which makes it sound like it might be my fault, but almost all of them that we did in the 90s, something has happened. There's one or two which are still joint ventures and they're still doing okay. But I even think in those cases, something will happen at some stage. So I think it's quite normal to have problems, and we'll talk a bit about why it's normal to have problems. And I think in 30% of the cases, the joint venture contract, life changed, the economy changed, maybe the factory had to move, maybe the business. We had a client who was doing a joint venture to do the old style TVs with the tubes. That disappeared within 6 months. It was strange. You had like the old TVs, and 6 months later, everything was a flat screen TV. So that joint venture just, disappeared very quickly. So 30% of the joint ventures, there's a problem. You can diffuse it, you can realign, you can maybe, buy them out, you might do something. Then there's another 50%, which is more serious. There's economic issues, and you need to have a more serious corporate restructuring. So it might not be just changing the management around a bit. Maybe the foreign partner has to take a clear lead. Maybe he takes 70 or 80%. Maybe he buys you out. Maybe the Chinese partner buys you out. Maybe you buy them out and they remain as a distributor. Lots of different things. This is the less happy version than the 30%. But then I would say, and this is not scientific, maybe about 20% of joint ventures just explode and it's a big mess. And these need some creative planning to get out of. And so the whole slide doesn't show up here, but I think the whole idea is here, when we talk about the strategic alignment, I think the problem is if you didn't really align when you were negotiating and signing, then these problems tend to come back later. And the Chinese say, same bed, different dreams. And I think this is an issue. It can be about compliance. It can be about marketing. It can be about the use of expats. It can be about the import equipment. It can be about whether the joint venture can export to a third market. It can be about your technology. There's lots of things that can go wrong if the interests diverge. And this is often the case if you hadn't actually really worked out what you want to do before you started the joint venture. And so, this slide, I won't go into great detail, but it's a simple slide and it's about sand in the machine. So, we set up the joint venture and we have to realize the joint venture is a separate legal entity from the shareholders. But all of them, almost any joint venture has a divided board and a divided management. So perhaps the foreign shareholder nominates the general manager, the Chinese shareholder nominates the deputy general manager. The board might have 6 directors, 3 from the foreign side, 3 from the Chinese side. And then I think, the most common issue is we have economic difficulties. And then it's often the Chinese partners who are more upset than the foreign partners. And very often the Chinese partners feel the joint venture have lost their way, and then they might commence competitive entities or activities, or they might complain. And the reason why I say it's often the Chinese partners that will start this complaining is because it was often the foreigners who insisted that they'd have to be the managers of the business. And so when there's economic difficulties, you tend to blame the managers. And then I think once we have this problem and people are arguing, a joint venture is really a bad system to come to an arrangement. So, first thing is, after the shareholders, we'd have the board. There's no goodwill at the board. Then we have the management is in dispute because the management is nominated by different parties. Then we have the breakdown at the shareholder level. And then we actually just basically have gridlock. Things might continue to work, but it's very, very hard to get momentum to make big changes. And this is the difficulty when you have a joint venture dispute. So I think I've already mentioned it very briefly before, but what's the biggest mistake after the lack of strategic alignment is the idea of total control. And, I remember one client years ago said, I must have 51%. And it was a Danish company. I said, well, why do you need 51%? Is it a financial issue, an accounting issue? He said, no, I need 51% because I need total control. And at the time I said to him, well, if you want total control in a joint venture, maybe you should have a wholly foreign owned enterprise where you own 100%. Actually, by now, I'm not sure you even have total control if you have 100% wholly foreign owned enterprise in China. So I think the issue is really with that 51-49, maybe at the margins there's something, but really if you think that you have 1 or 2% more, that you really have the critical say, that won't help you. If anything, these joint ventures are even more difficult to unwind because one side feels they have rights, which I don't think they really will be able to enforce in practice. Okay, so mistake number 2 is playing the game. And I think, just very, briefly on this, because I hope we can have time to have discussion, and people, please feel free to reach out. It's just that Daniel, I couldn't actually hear him. I think his connection wasn't that good. But I think the issue is when we have a dispute, it's how people play the game. And I think, a joint venture is a very complicated issue. And the first thing that people will have when they have a joint venture dispute is they will look at that old joint venture contract as if it will contain some secrets that will be a map out of the mess. And, of course, you have to look at the joint venture contract, but just restricting yourself to the joint venture contract, it's really like just playing noughts and crosses. And noughts and crosses is a game where if you have any level of intelligence, you should really not lose. It should always be a draw. But often international companies who deal with the joint venture dispute as if they're playing noughts and crosses, they actually even lose at noughts and crosses because they make such obvious mistakes. So I think it's more like a chessboard, and that means the joint venture contract's important, but so are the board resolutions, the emails, the supplier arrangements, and all these different things between the parties. Why are you valuable to the Chinese party? What's the role of the local government? It's much more complicated. There's a lot more moving pieces. And that will give you a much better chance of getting a good solution. But to tell the truth, if you really want an optimal solution, the game on the end there from the Big Bang Theory is something called 4-dimensional chess. And so I think beyond just the joint venture, you really have to look at where's the leverage points over the Chinese party, anticipate what they're going to do, because that's the other issue, which we'll talk about a little bit in a minute, is that very often the Chinese partner is always the Chinese partner is in China, and very often the decision makers are in the US, and it takes a long time, and it's very reactive. So I think you need to be able to move quickly on a number of different levels and think beyond just the joint venture. Look at the other relationships you have. Look at what is your best case alternative. People sometimes fight for years on a joint venture, but they never set up their own wholly foreign owned enterprise or something which could change the leverage dynamic. So the pirate captain, and I think people sometimes think it's a joke about the pirate captain, but I think if you've got a joint venture, it's different than if you're operating a joint venture which is going smoothly. So if you have a joint venture dispute, you need somebody who's not the same as a general manager. And very often the general manager and perhaps the Chinese deputy general manager, these two have been fighting with each other for a number of years. So it's very difficult to get them to solve the problem. And so why I use the word pirate captain is because in the old pirate ships, the quartermaster was in charge of the pirate ship, of the administration, and he would run the show when things were normal. The pirate captain would be getting drunk in his galley or whatever, and he'd only come out when the ship was attacking somebody or was under attack. So I think you need a different type of personality to deal with a dispute than the person who runs the company normally. And so you need to have somebody who is either very experienced but has won the trust of your company, and yet should be unconnected to the business, because there's really a big problem with inherent bias. If I'm an American company and I've appointed the American general manager, it's difficult for them to be neutral about what mistakes the American company might have made towards the Chinese side. They just always say it's all the Chinese are wrong. So I think it's someone neutral and understands how to deal with a dispute and is able to make a quick decision on things. And then information gathering, I think this is also the thing which is important. I've never found something very useful in a joint venture contract. I found a lot of useful stuff in emails. I found a lot of useful stuff in other contracts. And nowadays, if you can get access to it, you can find a lot of interesting stuff in WeChat messages. Because I think if you look at these kind of information, you can see the joint venture contract is a static thing which happens in one place in time. If you look at a year of WeChat messages, you can kind of see, with the benefit of hindsight, where people were starting to do things wrong, or they were doing things incorrectly, or where things didn't line up with reality. So I think it's very important to gather the information. Don't trust what people give you. We've had lots of cases where the management from the foreign side told us stuff, and when we actually did some digging, we found the information was just not true. Also in China, you can get a lot of information from the SAIC, now they're called SAMR, and they've got the corporate records. Normally, if you're a Chinese lawyer, you can just pick up those records, get a scanned version, and they can have a treasure trove of information. So I think it's important to get independent, objective sources and also collect as much information as possible. And you should do this before people realize there is a dispute. Because once you start with a dispute, a lot of stuff will go missing. The fourth mistake is, the inability to set a realistic target. So I would say most foreign people who come to me, or clients, and they tell me they've got this dispute with the Chinese partner. Maybe the Chinese partner's kicked them out of the building. Maybe the Chinese partner is not paying them for any outstanding orders, which the joint venture's given to the Chinese partner. Maybe the Chinese partner has taken over the management or something. And you say to them, and you say, okay, and you listen to their sad story, and you say, well, what do you want to do about it? And normally, I'd say the most common answer I get is, well, I would like the Chinese partner to comply with the joint venture contract. Now, this is not very realistic. It's not a realistic target. So I think before you do it, work out, what do you really want to do? What do you think you can do? Do you want to get out of the joint venture because it's non-compliant? Do you want to get out of the joint venture so you can start a new Chinese business and you're stuck in an exclusivity? Do you want to decouple the joint venture from the Chinese business? Do you want to get your IP and your production equipment, which has got all the IP in it, do you want to get that out of China? So these are all kind of things that we've had clients, and they were the motivating factors. And this made it easier to work out a strategy to succeed. Because if your only idea is, I want the Chinese partner to comply with my version of the joint venture, what I think it means, this is really, really very difficult to pull off. So I think the key takeaways here are, firstly, the most important thing I think is finding the right partner. I think if you got the right partner, you can work things out. And, you know, the longest standing joint venture, which I've worked on, and I used to be a director of as well, that happened over 20 years ago. They started with one joint venture. They've now got 3 joint ventures. It's between a relatively large privately owned German company and a medium-sized Chinese entrepreneur in Liaoning province. And they really have done well. He helped secure the local resources, like the natural resources, because it was a very specific type of product. But they also relied on him for his ability to work out how distribution worked in China. And so it shows you these joint ventures can be very successful. And I think now if we're talking about the 2020s, you might find the appropriate partner is someone like a Baidu or somebody on the Star Exchange, a Chinese company that has got lots of money, you know, like a Tencent or an Alibaba. You've got something which they would want, or I don't know, like a Newsoft, or there's lots of successful Chinese companies, and you know they run appropriately. And I think they're very keen to find joint venture partners who have a really interesting concept and technology which works well overseas. But if you could bring it to China, you could supersize that business and make it more successful. And so I think this is the kind of joint ventures we're seeing more and more of. I'd say the second thing is you should keep an open mind. The business practices, the culture, and the customs, it's very different. I never used to think this. You know, I lived in China almost exclusively from 1993 until 2018. I didn't really leave very often. And I always didn't believe these cultural differences. But when I actually left China and came to Europe, I realized actually it was more of a culture shock for me than when I first went to China. I mean, because I knew that China was very different. But there's all these little things that you don't realize. And a lot of the things which I always thought weren't true, like, you know, the importance of face and the importance of relationships, because I think, you know, Westerners also have these. They do matter, I think, a bit more in China, and they're a little bit different. So it's not about reading a booklet or a paragraph about this, but it means that you have to perhaps be a bit flexible and try to do a bit of thinking, like what's motivating the Chinese side. And then I'm a lawyer, but I'll say something about lawyers. I'd say if you're looking at joint ventures, don't make everything too difficult or too complicated or too hard. A joint venture contract is of a certain level of complexity, that's for sure. But sometimes I've seen so many things which I can just tell are boilerplate. They're not fit for purpose. It's wording that doesn't really make sense. I think it doesn't really work. So try to work out what you really want, have a reasonable document that protects your interest, but something that can actually evolve over time, and also, you know, the Chinese partner can live with. And so I think you need to be creative, focused, have the right kind of team, and also keep headquarters involved. So Daniel, I was going to just stop sharing the slides then, and you know, interested if there's questions. I don't know if I didn't know where the chat went now, but if there's any questions, be very happy to engage in the discussion.
So I have a question here.
Okay, am I coming through clearly now, Mark?
Yeah, that's better. Thank you. Yeah, I think you're on mute now.
Mute. So I'll read Jay's question. How do you protect your IP from a company like Tencent, who's the 800-pound panda in the relationship?
So look, I think this isn't such a, I think this is, so hi to Jay. I understand he's in an airport coming back to China. So yeah, thanks for joining, Jay. Look, I think the thing is, it's not going to be the Tencents of the world. I think if we look at IP, yeah, the biggest single problem with foreign companies nowadays in China is they didn't establish or register the IP. I'm not going to say that IP protection in China is fantastic, whatever, but I can say it's very different from 20 years ago. And our law firm is a Chinese law firm, and we have maybe like 3,000, 4,000 people in China, 13 offices. The single fastest growing part of our business is IP litigation. And so I think the first question is, what is your IP? If we're talking about patents or trademarks, register it. If you're a computer company, you don't need to register your software as copyright, because copyright just, is a right that just establishes itself globally. But if you spend $1,000 to register it, it makes it easier to take action. It shifts the evidentiary burden. And I think a company like Tencent, they're a very good target because they're so big. A claim of an IP infringement by Tencent would be a disaster for them. And I think that's why we're seeing a lot of increased IP litigation. And most of it is Chinese companies against other Chinese companies, is because a lot of companies now are listed, or they're on the Star Exchange, or they're planning an IPO, and they can't afford to have an IP dispute. So I think, just in summarize, look at your IP, establish the rights, protect them, have a strategy, and then work out who you're dealing with. And I think it's not that bad in a joint venture, especially if you pick the right partner. Okay, I think someone else had a question, or...
Okay, Mark, I'm not sure if I'm coming.
Yeah.
Clear.
Mark, I'll jump in since Dan has some
here.
connection.
Am I
Daniel,
coming?
maybe I've got the chat open. Maybe you could just write a little bit about your question, because I can't hear it, at least.
My connection's
I'll jump right. I just got a quick one. So I think, when you look at the last 30 or 40 years, China's relationship with the US and then China's relationship with the rest of the world, probably at the current moment, it's not in its best terms. How is that going to affect some of the JVs that you've been talking about in the current environment, with respect to some of the sort of international relationship China with respect to the rest of the world? Thank you.
Yeah, thanks. Look, I think it's an interesting question. I think, I think what we've seen is China, as somebody else said before, has become an innovator, and there's a lot of indigenous technology now. But they're still behind in stuff like semiconductors. And I think the US was starting earlier about being concerned about it. So we saw a wave of acquisitions of semiconductor companies. And I always thought semiconductor companies were like Intel. I always thought they were like these massive billion-dollar companies. But actually, a lot of them, it's such a fragmented business. So there was a lot of acquisitions in places like Holland and in Germany. And now the EU is also tightening it. I don't think it's as tough as the American. I know it's not as tough as the Americans. Europe has been very open to Chinese investments until recently. At the moment, I think the main problem in Europe is if it's defense related. And we did actually have a Chinese acquisition into Germany where I think it was very unfair, but the German government stepped in and stopped it, even though the documents were signed before the law came into effect and everything. So I think the issue will be the technology. And I think if it's something off limits for the Chinese company to buy the American company, there's going to be a lot of issues with licensing that technology to China as well. So I think we're just going to have to admit that certain types of technology, especially dual use defense technology, some telco stuff, may be too sensitive. But most stuff is no problem. And I think, I don't think many of our clients who are trying to do these kind of joint ventures with their tech, I don't think any of them are thinking this is a way to get around having a Chinese shareholder in the US. It's more like, I'm busy doing the US. I think I can do Europe, but China is too big. Why don't I just put my technology in? And if they can do something with it, it might be worth a lot. And then at least, I'm a bit involved, but I can concentrate on my core markets, which are easier for me. So I think that's kind of what we're seeing.
Can I just ask, as a slight continuation of the previous question, because of the political situation with China being more assertive with its foreign policy because of issues of IP theft, which a lot of Western companies are concerned about. Do you see a trend of Western companies actually deciding to either pull out of China or not invest any further in China and go to maybe India or some of the Southeast Asian countries to set up production facilities there instead?
So I think, look, I think the thing is the stuff that I've actually seen. I mean, I've read in the newspapers all this stuff. I haven't seen any client pull out of China because of IP concerns. I've seen people downsize, but I think everything I've seen has always been economic drivers. And so if you take something like the textile industry, it wasn't an IP issue. It was just that they thought it was cheaper to go to Bangladesh or, India as well. I think probably I haven't met a client who said, because my IP is at risk, I'm going to go to India. We met clients who said, either we don't want, and this was back in SARS days, there was a few cases where people decided not to have all the eggs in the China basket because that pandemic back then essentially hamstrung China. And so people didn't want to take the risk of having just one single place of sourcing their goods. But I think now some of our clients who are in more, mass market commodities or whatever, some of them have started to source from India or Bangladesh and not exclusively from China, but it's economics. I really haven't met a company that says I'm pulling out of China because I'm worried about my IP. I think anyone who was worried about that, they wouldn't have set up in China. That's probably the issue,
Okay, just one more follow-up question. Do you think the main reason Western companies want to invest in China is more cheaper production facilities or access to the Chinese market, or both? And which of the two is the greater?
It would have been from 1990 until about 2005, it would have been this concept, maybe 1990 until the early 2000s, it was the idea of a organized, compliant workforce. We could manufacture for export, etc. Or we're manufacturing for the Chinese guys. We make big things for Chinese companies that make smaller things and stuff like that. I'd say around 2005 or so, everybody that I met was mostly interested in the Chinese market. And that would be even the suppliers, the tier one suppliers for the automotive industry. They were wanting to supply the Chinese companies making the cars for the Chinese consumer. And then I would say, after that, there was the next bump where people that wanted to supply the Chinese who were supplying everybody in the world. So, one client was the company that does the railway, a certain part of a train. And one of the reasons they had to be in China was because they also wanted to supply China in Africa when they build the trains for Africa. So that was the other thing. But I'd say now, if I look at our business now and we look at new joint ventures, for every one which we have, which is like a manufacturing joint venture, we probably have 10 or 15, which are something like a cosmetics company, a digital company, a SaaS company, a autonomous driving joint venture. All the joint ventures are all about the Chinese consumer market. And then there's the occasional one. The one which is not about the Chinese consumer is the outlier. It's it could be something like a rare earth company because China has most of the rare earth in the world. But really, I don't think I've met anyone in the last 10 years who says, I want to build a factory in China because it's cheap to manufacture. But that might be just the clients that we attract. But that's what we've seen over the years, I think.
So I have a question from May, who's going to unmute, and then I'm going to read Daniel's question.
Oh, okay. Yeah. Hi, Mark. It was great presentation. I have a question on the CFIUS, that if you can talk a little bit about that from US perspective, because I work in the pharmaceutical industry and trying to connect to some of the entrepreneurs, but the IP lawyers just asked me to stay away from this because of that, so I just wanted to get your insights.
Okay, thank you. So look, I am a lawyer, which means I'm bad, but I'm not a US lawyer, so I'm not totally a bad guy. So I'm not a US lawyer, so I can't really talk about CFIUS from the US perspective, but I can just talk, our law firm is a very large Chinese law firm. and we've helped many Chinese companies go abroad. And I would say, I would guess, probably the amount of Chinese companies who are investing in the US, it's really dropped off 70, 80%. So a lot of companies are very concerned, and very often the issues that clients have faced, and I haven't been involved in these projects, so I don't do it, but I just hear around the traps. It seems as if it was hard to see that there was really a strategic problem with it. So I think if I'm feeling this, the Chinese companies are feeling this very intently as well. So I think there's not much appetite. They're still trying to do it, and I think there's more IPOs in the pipeline for America than there used to be, even though, you know, all those other issues. But I think CFIUS was earlier, and that was a pipeline. And so I think it's difficult. And even with, you know, the change of the administration in America, I don't think Chinese people are thinking it's going to be easy. I think they probably think Europe is an easier place to buy technology or invest in companies at the moment. So that would be my feeling. It's not something that's easy to overcome. But I think the other way is for the Chinese entrepreneurs, they might be, if you've got, I think you said you were life science or pharmaceuticals, you know, they could have a very big interest, not in investing in the company, but pharmaceuticals, it wouldn't be a prohibited technology or something, you know, overly sensitive. So it might be possible to do a licensing or do something with that where the Chinese funds it, because I think then the Chinese will feel they've got much more control. It's much less risk. They don't have the foreign exchange issues. They know how to add value. So that's why I think joint venture, I should have actually mentioned that before. That's one of the other things I motivate is the joint venture is for these rich Chinese companies, it's easier to do it in China. No foreign exchange, no approvals, just do it. You know, it's easier for them.
So Lisa mentioned that she subscribes to your YouTube channel, China, Art of Law. I don't know if you want to touch on that at all. But then Steve, I don't know if you answered this during the conversation. He was talking about General Motors. He was the first managing director of Shanghai. And then Lisa also asked about Tesla. So did you touch on that?
I think I did, but I mean, it'd be great to hear what Steve says about, you know, being at the coalface at General Motors. It'd be very interesting to hear what he would comment on.
Well, the SAIC GM joint venture was the second vehicle venture that GM did. The first one was a complete disaster, but it was a mandated joint venture. And that mandated joint venture told us if we do that one, we could do cars. We started the project in 1992. I moved to Shanghai in 94, and we completed the joint venture in 97. We were fighting against Toyota and Ford, and there happened to be a spy on the opposition side working for Toyota. So anything we proposed, Toyota beat us on. Eventually we won. It was a long drawn out process, but we had a large number of people that knew how to deal with China. I had started working in China in 85 and moved to Shanghai in 94, so I had a little experience. One of the strategies we did was to do components first, build up an infrastructure where you had parts available that met our standards. That showed we had good faith and we had some good quality. So that led us to get into the vehicle business. We also had a very good lawyer who made sure there was no boilerplate and all the terms were very easy to translate. Back when we were doing it, getting people to translate properly was a challenge. Overall, it worked out pretty good. In terms of what Tesla is doing, I think a lot of what we did back in the early and mid 90s opened the door for a lot of other people. You know, we had a good partner. They had some experiences, not the best quality, but they knew how to do things. They also had connections within the central government, which also helped. Guangxi was very important, but having knowledge of the people, how to deal with the people, and establishing your own relationships with your counterparts, that was extremely crucial to the whole process. overall, it worked out very well. We started off at 50-50. Then when GM had financial problems, GM sold part of its equity to SAIC in order to get cash. But it's still profitable. And they sell more Buicks in China than we do in the rest of the world.
Well, that's a bit like Shanghai Volkswagen. I think they never sold a Santana anywhere else outside of Shanghai. And so I think a lot of those automotive companies, that somebody once asked me a question, like maybe 10 years ago, and I wasn't ready for the question because I was very surprised. And it was somebody said to me, have you ever heard of a joint venture or wholly foreign-owned enterprise making money in China? And most of my clients in the early 90s were German companies, and most of them were in the automotive industry. And they never made as much money as they did in China through selling semi-knockdown kits, the components. They were making so much money, it was incredible. So I guess it was just being in the right business at the right time.
But when we tried to go in, we were not allowed to do a knockdown kits. It had to be manufacturing. We started off with 60% Chinese content from day one.
Yeah.
And we increased it from there. And then in 2017, we had the first exports of Buicks from China to the US. So it took 20 years to export the vehicles, but it worked.
No, but I think it's instructive what you say. It was, firstly, you had the right partner, even if they're a little bit difficult. We also did some work with Ally when they sold out their auto financing, and SAIC and GM bought it. So we're working with those guys. So it was like an ambitious Chinese company, but it is a bit like dealing with the state. So it's not like a private entrepreneur. Yet it's got its own challenges, the process of making a decision. But I think, it's really important what you say too, is how to get to know the people, build a relationship with the people. And I think a lot of people forget it. And also that contract in the Volkswagen negotiations, I wasn't there because that was a bit earlier than me. But my boss who was there, he was the first deputy general manager of Volkswagen, even though he was a lawyer. And they had a guy, maybe you dealt with him, they called him, the nickname was Shakespeare. So SAIC's lawyer who was doing the contracts, he was called Shakespeare. And the contract, I saw the joint venture contract for Volkswagen, it's like 12 pages long. It was too short, even by my standards, but it was kind of interesting.
Well, I think our joint venture contract was probably close to several hundred pages, but there was an awful lot of technology that was included in there.
Okay, these were in the annexes, but anyway, sorry. So
I'm going to ask Jay's question before I ask Daniel's, just in case Jay has to jump on his plane. And he asked, recently I was told for the first time in modern history, China surpassed the US for FDI. Can you comment on that?
Yeah, well, I don't know when it was. It would have been, I don't know if it was recently. There was a year where China was #1. And, it's like, maybe 20 years ago, China invested, nothing, and the scale goes on that. And I think this again goes to that joint venture reason. 20 years ago, 25 years ago, nobody thought China would invest overseas. And then I think probably it was like the high point for our law firm, I think would have been around 2018, I would guess, 2017. And there, I remember there is a point where China exported more cash than imported in foreign FDI. And, I think that would have been the time when China surpassed the US, but it would have been only in that year. I don't think it would be cumulative. And, things are slowing down a bit for the Chinese, also because of foreign exchange. They've made a lot of bad bets. A lot of the investments they've done overseas haven't panned out. And that's another reason why I think actually more foreign companies will come to China, because it's easier to be successful here. Well, I'm not here, but if I was in China, I was here. Easier than trying to run something overseas.
And Daniel's question is, what is the best way to manage the record keeping of messages and document sending when WeChat is the more popular platform for China teams rather than email?
That's not easy. But I think the good thing about WeChat is, if we're talking about a joint venture, so we've got WeChat Work, which I never really used, but our law firm uses WeChat Work, and I think they can keep a record of everything and they can stop things and block things. But even say if it's a joint venture dispute, so if Steve was engaging in WeChats with his Chinese counterpart, on his phone at least, you'll see all the conversations. So it's not always you have to like get the other guy's phone. You just have to find the person he's talking with, and you can see how a certain piece of information come together. But I don't think there's any way you can just get the WeChat remotely, by getting it in some other way.
So does anybody have any more questions? Now's your time to do it. And Lisa, did he answer your question about Tesla? Or did we answer the question about?
I didn't see the question about Tesla.
It was sort of tacked on to Steve's question.
Okay. Well, Tesla's got a new deal. It's something I wouldn't think was possible, but I think they were allowed to set up 100%, where, like Steve said, it was always 50-50, which they've slightly relaxed. But Tesla, I would have told them it's impossible, but they got it through. So it shows you China is becoming more flexible. And you can even see with the Trump trade war with China, it's a bit like CEPA. CEPA's the Hong Kong agreement. And so, we always had in China a list of foreign investment categories, ranging from prohibited to encouraged to permitted to restricted. And, CEPA was for Hong Kong companies. Hong Kong companies had better access than anybody else. And then with the trade war, Trump got better access in some areas. And now with the European investment agreement, they will seem to get better access in some areas too. So now it's a little bit, not just what you do, it's where you come from as well. So it's a little bit more complicated than it used to be.
If there are no more questions, on behalf of the FENG.
Charlotte?
Oh, sorry, go ahead.
It's very simple, just a quick one here. So
Take your
Mark,
time.
if you can share maybe your contact information, and for those of us who want to reach out to you for potential opportunities to work with, whether it's in the Zoom chat here or via email, that would be great. Thank you again for sharing. It was great. I really enjoyed it. Thank you.
Oh, great. Thanks for the vote of confidence.
And Jay is saying he meant China's the recipient of the most FDI.
Oh, that probably happened a lot of times. America never wanted FDI. I remember the American Commercial Bureau guys back in the until the 2000s, they were always surprised if they ever thought they were supposed to ask Chinese to invest in America, because they always said, America, we invest in other countries, but other countries shouldn't invest in us. They should just go away. So I think Americans were never too keen on foreign. It was at least my understanding of the American perspective.
So did you want to take a minute and add your, Mark, add your information into the chat? There you go.
I just added an email address, and I'll even, like, since Lisa mentioned it, I'll just quickly put in our YouTube channel. If people wants to find it, I'd be very excited. It makes me happy if people have a look at what we've got on there.
So Daniel asked me to do the exit here because of his internet problems. So on behalf of our chapter chairs and the FENG, Mark, we really want to thank you very much for this very informative talk. It is being recorded, so I will send the Zoom link out to everybody who's on the call, as well as the people who registered later today. So thank you very much, Mark. I also want to thank our members in China who stayed up so late for this. And also to thank our chairs, because without Jay, who's sitting in an airport, and Daniel, who's up till 1 a.m., we couldn't operate. The FENG is really based, we need our volunteers, we need our members. So thank you to everybody. And just please check back on the new website, which is up and running for the next meeting for Shanghai. So if anybody has anything else they'd like to say, last chance. Otherwise, thank you again, Mark. Sure.
Just one quick question, Charlotte. Mark, it might be a silly question, but would I be right in thinking that apart from a few exceptions that you just mentioned, that if you wanted to trade with China, you would basically have to go through a joint venture route rather than having a 100% owned company?
No, I think it really was never like that. Even in the early 90s, there was always lots of exceptions. But I'd say, at a guess, 95% of the clients we have could do it as a wholly foreign owned enterprise. There's only narrow bans. If it's something with telco, financial institutions, something like electronic mapping, I don't know, rare earth exploitation or something, certain types of diesel engines. So really, probably 95% of stuff you can do as a WOFE. So I think there's some who do it because of legal reasons. Then there's a bunch who do it because they like the Chinese partner. And then there are some who just think, this will get me the market access. This is the way to do it. So that's something really worth, thanks for mentioning, because sometimes I don't realize that people don't realize it. China is very open actually to companies. So for 90% of the companies out there, they can set up their own wholly foreign owned enterprise. Okay, thanks for that question.
Now this really is the last chance for any questions. If not, well, thank you again to everybody for joining us, and please enjoy the rest of your day, evening, and see you soon. Thanks again.